In recent years, a new force has emerged in the global financial landscape. It is not a traditional superpower, yet its influence is strong enough to shake the foundations of the US dollar. This region controls the world's largest energy exports and holds trillions of dollars in capital. Now, it has begun shifting energy trade away from the dollar, turning instead to the euro, the renminbi, and even its own local currencies. In this video, we start with an oil crisis, an event that forced these countries to rebuild their financial structures and step onto the global stage. While the world's attention has been locked on two nations, the United States, at the heart of dollar hegemony, and China, the most active promoter of de-dollarization, but another region has long been overlooked. It may not dominate the headlines, but every energy price it sets and every capital flow it directs has the power to challenge the dollar's dominance. That region is the Middle East. For decades, Middle Eastern economies relied on a simple model: selling oil. Each barrel was like a mountain of gold for their treasuries. But the pandemic shattered that model. In April 2020, oil prices crashed below zero. WTI crude closed at -$37, meaning producers had to pay buyers to take delivery. At that moment, they realized, change or collapse. This oil shock triggered a financial revolution. They needed to ensure capital was no longer tied solely to oil, but free to move globally and fuel a second engine for their economies. In the early 2000s, Islamic finance was built on a few core principles. A ban on interest, riba, practically replaced by structured returns, avoidance of excessive speculation, gharar, and exclusion of sectors like alcohol and gambling. Products were dominated by murabaha, cost plus sales, ijara, leasing, and mudaraba, profit sharing. Investments focused on domestic banks, real estate, and infrastructure. Safe and compliant, but low in liquidity and limited in global reach. Nowadays, Middle Eastern nations began working with international fund managers to design Sharia-compliant products, Islamic bonds, sukuk, private equity funds, infrastructure and energy funds. These products preserve a religiously compliant structure, yet allow capital to flow into global equities, technology, infrastructure, and even sports. Islamic finance has transformed from a conservative, regional capital pool into a liquid, flexible force in global markets, becoming a financial weapon for Middle Eastern nations in the push for de-dollarization. Qatar is one of the world's largest liquefied natural gas exporters. Its importance grew further during Europe's energy crisis, as clients expanded beyond Asia to include Germany, France, and Italy. The Qatar Investment Authority now manages over $500 billion, with holdings ranging from London landmarks to US tech firms and European football clubs. In recent years, Qatar has settled energy deals in euros, renminbi, and even local currencies. With China, there are already contracts signed in RMB. This flexibility makes Qatar a pioneer in diversifying currency use in energy trade. Saudi Arabia is the birthplace of the petrodollar system. In the 1970s, it struck a deal with the US. All oil exports would be priced in dollars, in exchange for American military protection and economic cooperation, laying the cornerstone of dollar energy hegemony. But that foundation is now weakening. In 2023, Saudi Arabia declined to renew the half-century-old agreement, signaling openness to non-dollar settlements. The Public Investment Fund manages over $900 billion, investing in sports, global ports, renewable energy, and AI, highly strategic sectors. Although most Saudi oil is still traded in dollars for now, the shift has already created an unprecedented challenge to the dollar's monopoly in energy. Iran is the outlier of the region. Crushed by US sanctions, it was cut off from the SWIFT payment system as early as the 2010s. Forced to adapt, Iran developed alternatives, trading energy with China, Russia, and Turkey using local currencies, gold, and even barter. Though its economy is smaller than Qatar's or Saudi Arabia's, Iran's experience provided others with practical models and technical pathways to bypass the dollar. In other words, Iran became a live testing ground for de-dollarization survival. Together, Middle East countries command a significant share of global oil and gas exports. If they collectively shift away from the dollar, its dominance in energy pricing would erode. The sovereign wealth funds of Qatar and Saudi Arabia alone exceed $1.3 trillion. With the rest of the region's funds, The total reaches several trillions, capital not only seeking returns but building influence worldwide through infrastructure, technology, and sports investments. By using Sharia-compliant finance, these nations remain rooted in local culture while actively engaging global markets. They have become one of the few forces able to bridge both worlds. De-dollarization is not just a contest between China and the United States. With their energy exports, capital power, and financial flexibility, Middle Eastern nations hold real leverage over the dollar's future. For America to preserve its hegemony, and for China to push renminbi internationalization, both must face the same fact: the Middle East now controls the initiative in energy settlements. As these nations embrace currency diversification, the global financial order may already be stepping across the threshold into a new era. If you found this perspective helpful, don't forget to subscribe and share. Your support helps us keep exploring the logic behind global finance.